In this video, we will be looking at dividends, and in particular, some of the objectives discussed in this video include the definition of what a dividend actually is and why do they exist in the first place. We'll also look at yields in terms of percentages and how we can track dividend data. We'll also look at the tax implications with respect to receiving a dividend and why your tax rates are generally lower when receiving a dividend versus, say, taxable income from a job, for example, a part-time job or a full-time job. If you get a dividend from, say, a limited company, you might be able to reduce your tax burden. We'll show the exact implications with respect to the UK shortly. We'll also have a look at some of the issues with businesses that pay a dividend and why we may be wary of investing in such for the long run, but we'll also look at why they may be good investments, and we'll bring up the importance of having liquidity for pension funds and having them take part in future fundraisers, but being able to do so because they are invested and receiving a dividend, which gives them liquidity. But we'll talk about that in a bit, and we'll finish this video off by looking at the impact of dividend cuts and hikes on a company's share price on the public exchange. So let's begin. What are dividends and why do they exist? Well, a dividend, the easiest way to think about it, is when a business has excess capital that they can't put to use. They got money that they can't put to use and generate a decent return. They decide to pay it back to their shareholders from its total profits. And then you take dividends out and all of a sudden you have this figure called retained profits. Now, there's a theory out here. It really talks about this whole explanation we just talked about. If a company can't get good enough returns on capital investment from different projects that they may be able to choose from at the moment, say additional projects on top of everything that they're doing, they'd be better off giving that money back to shareholders via dividends, because if they can't make more than a certain amount needed, it's better to give that money back to shareholders until they need it, to be fair to them. Now, to also ensure that regular payments are made to pension funds, a business would be paying a dividend. So let's give the example of a pension fund. Let's say a pension fund invests money for you, right? If you're not familiar with what a pension fund is, they generally hold investments of funds and make investments for individuals before they retire. When you retire, you're eligible to take this money out. In the UK, it's around, I think, 67 at the current moment. I wouldn't be totally sure, and it differs in different nations. But once you reach that age of retirement, you're allowed to take that money out. There are some conditions where you can take that money out before retirement age. I think there's a lump sum, 25% lump sum in the UK, around the mid-50s or something like that. But that's not important in this case. Let's say you have your money in a pension fund and say you've got, I don't know, £1 million, and then you want to take that money out. The pension fund has to sell those, when you're selling the units in the pension fund, they have to sell that amount of diversified holdings across their portfolio. And sometimes they can't do that in one go, so they need some form of regular liquidity, some form of money coming in at a regular time. So say annually or semi-annually. That is through a dividend, and when a business pays dividend to these shareholders, which include pension funds, they have income coming in and they may be able to be loyal, holding their shares, and if there's a future fundraise, they'd be able to take part. But if they don't have that dividend income, how are these pension funds going to pay people withdrawing money? So they would be forced to sell shares in the company if, say, it went from paying a dividend to not paying a dividend. We'll also look at the concept now of what a dividend yield is. If you've heard of this before, you can see this familiar formula. If you haven't, a dividend yield is essentially the percentage rate of the current share price, or the shares that will be paid out in, say, a year in terms of dividends. So let's just say the annual dividend rate per share is a certain amount. You take that and you divide that by the current share price times it by 100. We'll give you a quick example here. We'll use company X. Let's say they are trading at £10 a share and they decide to pay an annual dividend of £1. How do we calculate the dividend yield for company X? Well, we get the £1 dividend that's being paid and we divide that by the £10 current share price for company X. We times that by 100, that gives us a 10% annual dividend yield. So this company is paying out £1 per share in terms of a dividend per year. And with respect to their current share price, that is a 10% annual dividend yield. So you would get 10% paid back to you if you held their shares. Now, how do we track dividend data? Well, a lot of the time you can look on a company's website. They've got their financial calendars, and this is one screen grab from Imperial Brands, a company that deals in tobacco. You can see a mention of their dividend payment coming up. We've also got the colors of BP, the oil and gas exploration and production company, where we can see the fourth quarter dividend being paid in pound terms, roughly 8 pence per share. In dollar terms, we have a different situation with respect to their shares, as they have, say, less shares listed, then the dividends more, but it works out to be the same equivalent. So we can track using financial calendars, we've shown here, company websites where we found both of these bits of data on, and regular trading updates where a company mentions about what it's going to do. There's also a website called Dividend Max. I believe, though, you may need a paid subscription in some aspects, but there are certain sites around there where you can just track dividends, upcoming ones, past ones, ex-dividend, and a pay date, which we'll probably look at now. You've got to remember the difference between an ex-dividend and a pay date. An ex-dividend is the latest period in which you have to be invested. You have to hold the shares of the company to be eligible for the dividend. And the pay date, simple in the name, is when you get paid the dividend. And if you're thinking right now, why not short the shares around ex-dividend and on the pay date close my short? Well, the way it works is if you're short, you will be liable for that dividend payment. So you would have no change in P&L. So if the shares paid a dividend of 4% and the shares only fell about 3.5% in total, you'd be down 0.5%. So don't try and short a company for the sake of it paying a dividend. If you are shorting, you'd be shorting in the longer term. You wouldn't try and have arbitrage in this situation. Don't fall for that trap, because a lot of people initially try and be smart, but in this case you can't. We'll also look at the tax implications of dividends right now. This is with respect to UK tax legislation. So if I pull it up right here, we can see the tax brackets and the rates, the relevant rates for income tax. You've got a personal tax allowance up to £12,500. That's where you pay 0% tax. You've got the lowest boundary of those who actually pay tax, your basic rate, and that is between £12,501 and £50,000. You pay 20%. So if you're earning £30,000, you take away that personal tax allowance, and then on what remains, your £17,500, you pay 20% of that in tax. With a high rate between £50,001 to £150,000, you pay tax of 40%. So of any income in this bracket, you pay 40%. Of any income in the basic rate bracket, you pay 20%. With the additional rate side, above £150,000, whatever's in that bracket, you pay 45% on. Now, why do we have this section below here? Well, this is with respect to dividends. Now, if you own a company and you pay yourself a dividend instead of paying yourself, say, a salary, then you would be paying dividend tax. So the basic rate here of dividend tax, say if your total personal income kind of goes in between there with the dividend, you'd be paying 7.5% instead of, say, the basic rate. If you were earning the income from any source other than dividends, then you'd be paying 20%. So your difference is 12.5%. If that's £10,000 in between there, in terms of dividends, you'd pay £750. With personal income, you would pay £2,000, which is a lot more than you just declaring that as dividend income, for obviously following tax legislation and the rules out there. So there's also a thing we should consider here, the dividend tax-free allowance. You've got a personal allowance, you've also got a dividend tax-free allowance for investments. Now in the UK, the current tax-free allowance is £2,000 for the tax year beginning the 6th of April 2019, ending the 5th of April 2020, a little bit earlier than the time of which this video is being recorded. And as we've mentioned, if you declare dividend income, say you hold shares in a company and instead of selling the shares for a capital gain and making, say, a certain amount of money, you can buy a dividend share, a company that pays, I don't know, a certain amount that equates to, say, £10,000. Then you would pay that basic rate if your total income puts you in that basic rate bracket. If you're in a higher rate of tax paying with your total income, then your higher rate for dividends would be 32.5%, still less than 40%. Everything counts with additional rate, 45% versus the dividend lower tax of 38.1%. So say if you have a property company, say that you include your costs obviously within fair accounting practice, faithful representation as they tend to call it. You get your final income at the end and you declare that as a dividend because you say have many investors in the business, then that will be paid at a lower rate each time versus, say, a personal tax situation. And you can see that the tax savings are much more noticeable for taxable income below £50,000 because you see 20% versus 7.5%. There is a greater difference between there as opposed to the high rate, 32.5% versus 40%, or the additional rate, 38.1% and 45%. It gets lower. Your benefit gets lower as your income increases. So for those earning lower amounts, it's a great way to save some money. So let's look at some of the problems with dividend paying businesses. Well, if you're paying a dividend, you're essentially admitting that you cannot reinvest those funds more efficiently elsewhere. And if you are a business that has good management and efficient capital allocation methods, then it could be a better idea to keep those funds in the business and reinvest them into new projects. And dividends can also show whether management is in it for the long term or the short term as, say, an invested individual. So if having a dividend or hiking a dividend increases your share price for the sake of unlocking bonuses just for you to move on elsewhere, you acting in your own interests as a manager may not be great for investors in general because in the long run there might be a shortfall of cash. And generally, if a manager sells shares, then they are going to spook investors. What if they own a lot of shares, unlock some options, and then pay a dividend? They're unlocking cash. They're essentially not selling shares, but they're getting a fair amount of money from the company without actually selling shares. It's almost as if those shares are worthless, but they generate, say, on a dividend yield of 10%, they take 10% of those shares in terms of profits, and they keep the shares as well. So when they want to leave, they sell out, and it's not their problem anymore. That's a little worrying situation. But if you've got the pension funds there staying invested, then a business is able to raise money in the future without as many problems, say if they didn't have these big dogs involved. But the indication of the level of influence of institutional shareholders on management is also shown by this. If a business is forced to keep a dividend just to keep these pension funds invested, it can show how management may try and satisfy certain shareholders but not others. And we'll also, to finish off, look at the impact of dividend cuts and hikes on a company's share price. So, although each situation is different, dividend policy changing a little bit up, a little bit down, differs in each situation. The general idea is that if you have a reduced or scrapped dividend, you normally see shares fall in value. That's because you have lower investor confidence, because a company all of a sudden can't afford to pay it. Maybe they have cash flow issues, and then things go from there to just get uglier. Shares end up gapping down in most equity markets when this kind of thing happens. When you have a higher or a new introduction of a dividend, on the other hand, shares are likely to rise. This isn't in every case, once again, but the general idea is shares are likely to rise, and that is because you have increased shareholder confidence, because all of a sudden the company's probably making a lot more money and things are looking much brighter from there.